From the morning reading, the S&P 500 snapshot down 1.26% for the week, but a fractional 0.27% gain for the month. Dollar continues to weaken as euro and yen rally. That favors higher commodity prices and gold in particular. Gold indicators support higher prices. So does the fact that gold miners are rising even faster than the commodity. Energy Spider also looks strong. Technology Spider pulls back to the 200-day moving average, and the S&P 500 pulls back from overbought condition. Earnings for the S&P 500 are set to decline for the sixth straight quarter. That's the longest stretch of declining earnings since 2009 and 1986 prior to that. Going back more than 140 years, such long streaks of poor earnings have often come near the end of a decline, but not consistently enough to suggest that the worst is necessarily over. The worst 6 months is about to begin. The summer months have traditionally been weak for stocks, but this month the S&P traded above its prior 12-month closing high. When it has been this strong in other Aprils, the summer months have showed positively skewed risk-reward ratio during the next 6 months. Mutual funds reduced their cash again in March. They are now holding 3.5% of their assets in cash, down from 3.7% the previous month. This has become less of a useful indicator in the past 5 years, likely because more assets are diversified into ETFs. That makes it less likely that we'll see forced selling from mutual funds due to a flood of redemption requests. Spiders, diamonds, IWM, bull flag patterns form hammer as buyers return in late trading as volume spikes. 2 of 9 sectors moved higher on Friday. XLU, XLY, and XLE were the strongest sectors, while XLV was the weakest sector. Oil futures rose 11 cents to close at $45.99, its highest close since November the 5th, 2015. Breadth strengthened as decliners led 1.33 to 1 on the New York Stock Exchange and 1.77 to 1 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:15 a.m. Central Time, and I am recording this in preparation for the market day of May the 2nd, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into our morning report. And relatively benign activity last night coming into this morning. At the time of this cut, all 4 broad market U.S. indices were up, but just barely. And the S&P, the NASDAQ, and the Dow all basically just above scratch. Only really the Russell even meeting the threshold to comment on, up about 0.25%. Crude oil down about 0.25%. Euro up about 0.25%. Bonds right at scratch. And that's probably 4/30 seconds. Sorry about that right there. And gold is up sharply about almost 1%. In terms of overseas action, China down about 0.25%, Hong Kong down about 1.5%, Japan down sharply 3+%, Germany is positive, almost up 1%, and the United Kingdom is down by over 1%. And I just noticed here, take a look at these dates, 4/29, 4/29, 4/29. We may have some markets closed. So, these numbers on China, Hong Kong, United Kingdom probably refer to Friday's activity, and it would appear that those markets may be closed today. That may also give us some reason why our own overnight markets were so quiet if the overseas markets were largely closed as well. In terms of the macroeconomic reports for today in the United States, we're looking at ISM manufacturing, PMI, is really the only significant report of the day. Looking ahead to tomorrow, we have an FOMC member, Mester, speaking. And that seems to be it. So relatively quiet the first 2 days of the trading week. In terms of market conditions, let's take a look at volatility. And short-term VIX of 14.79. This has been, slowly increasing of late. Skew still just above the threshold to comment on. IV percentiles, these have been climbing a little bit, but they're not even out of the lower quartile. IV percentile for the S&P of 15, the Russell of 15, the NASDAQ of 21, and the Dow a 12. No standard deviation moves were put in on Friday on any of the 4 broad market U.S. indices on a close-to-close basis. And let's go ahead and bounce over to the charts. We'll start with the S&P charts. And you see, we've had some pretty interesting action here of late. We had this channel drawn earlier, and remember, we were up against this area of resistance, and that seemed to fight off the bulls. But the bears, are they really achieving anything of their own? While we had certainly a significant probe underneath the channel, you notice that we closed right at the channel, and then action thus far today is right in the same area. So it bears watching, and certainly we had a break of both the diagonal and the horizontal support with the action of Friday, and that takes us to a different market phase, and we'll comment more about that in just a minute. But so that was significant, but yet we're still waiting to see some confirmation of this price action, and that this wasn't just kind of a trap. So very, very, very tenuous kind of situation right now with the S&P 500. We'll go ahead and take a look at the Dow and see if that gives us any more guidance. It looks very much the same situation. And then the NASDAQ has clearly broken down. This is more than just a probe. This is a confirmed breakdown, and in fact, we're already down to the cloud on the NASDAQ, so we'll see if that cloud does serve up as some support. But NASDAQ in a clear breakdown, being led by some major earnings reports on some of its major components. And then finally, the Russell is still probably in the channel. So when you look across these 4 indices, you've got Russell probably still in the channel, though on the weak side of the channel. You've S&P 500 and the Dow both, right at that point of breaking down, and the NASDAQ has already broken down. Let's see if the volatility tells us anything. Volatility has spiked, but then come right back to the top of that near resistance area. So very much like the S&P and the Dow, we're having to try to figure out if this is a false breakout or if it's the start of something bigger. You take a look at the VIX. You could argue that the VIX is coming into some significant resistance area of its own. And bonds perhaps are the clearest sign that something may be brewing, but yet it's right up against the top of the cloud, has not yet broken out. It appears to be up against some significant trailing resistance, and could easily roll back down. So we'll have to see. We're clearly fighting it out across these different markets right now as to whether we're going to have a more significant pullback and turn into something bigger, or if this is just another bull flag pullback, another test at the bottom of the channel, and then up we go again. Now, one market that has been doing something much cleaner is gold. And remember, we talked about coming into this apex and looking for a breakout, probably to the long side, and boy, did we get that. We got a great big, huge breakout candle, followed by huge confirmation, and then Sunday night it is continuing. So gold could be on something very, very large. Give me just a second here. Let me change this to a longer time period. And many people are suggesting that we could come up here at about 1400. And you notice this swing high here is, we'll call it about 1388, and this swing high here a little over 1400 body, right just above 1400. So that an area of resistance would come in right around here that you would target to get out at about this 1380 and change area would certainly make sense. We've got a gold position on in the trading room, and we certainly are not in any hurry right now to take that position off. This is potentially, and gold is often very volatile, and just when you think you know something, it will slap you. And but this is where these kinds of moves come. When you take this right here and you get this explosive move that eventually goes into consolidation. Well, we could be at the beginning of another explosive move that takes us, and in this case, we went from 1,045 to, we'll call it, before we had any consolidation, up to 1,264. What is that, a 25% move? That is a gigantic move, and especially if you're using options with your play. But we could see another large move as we move out of this area in gold. So just kind of keep an eye on that market. That is probably the cleanest breakout definition that we have right now in any of these primary charts that we follow. Let's go ahead and go to our daily report. There are some changes here, and I made kind of pass and mention a moment ago. This market trend intermediate term phase opinion, the first change we've had here in weeks. This is now at a phase 5. This is called the end short term, the break of diagonal / horizontal support. And frankly, on the S&P 500, we did break both diagonal and horizontal support with Friday's action. We go from there to our 3 mechanical market timing signals, and we have 3 of them that we follow. And the first one from IBD, uptrend under pressure, has been in a cautionary stage for a number of trading sessions now. It also gives us this NASDAQ with the accumulation distribution score of a D+. S&P still holding on to an okay score at a B-. If it drops to a C, though, it will also drop into warning status. Also note the GMI index. This has dropped to a 3 out of 6. It's holding on to the buy signal that's been in place since March the 2nd, but the more sensitive GMI 2 is at a 1 out of 8. This is just barely holding on, I suspect, and could very easily deteriorate into a sell signal at any time with any market weakness at all. And our third mechanical signal from decision point scoreboard at stock charts, you notice that short term is very, very pronounced to the negative side. There's still some green holding here, but definitely been deteriorating after being strongly bullish in both the short to intermediate term for some time. This had been up against the face of a long term that had been bearish, had started to turn bullish, but you were saying, well, who's going to win here? Is the long term the dominant factor, and these in short and intermediate term were just simply a big bear market bounce, and then they're going to run up against the bigger time frame and then roll over? Well, if you look at the charts, that would seem to be the argument right now, that we have made up the easy ground in a bear market, intermediate term, long-term market, and then just ran up against this and then just stopped in its tracks, and in the end achieved nothing, and is now rolling back over and resuming the long-term trend. Now, if that's actually what's happening here, then we'll see that this will continue to deteriorate, and those charts will start to confirm those reversal patterns across those resistance areas right in the next several days. In terms of position sizing opinions, definitely getting some caution here. We're at 50% on the portfolio position sizing opinion, and then we're also at 75% on the more active trader volatility-based system. In terms of the market posture, intermediate term, it is now weekly bearish, and you notice that the S&P, the Dow, and the NASDAQ all have turned bearish on the intermediate term. This is against a strongly bullish sentiment line, which is a longer term, less sensitive indicator, but it was up in the upper reversal zone itself. So certainly kind of setting up for something of a reversal. Now, the Russell is the one index that's still holding on to a very strongly bullish intermediate term posture in the intermediate term. So kind of keep that in mind, but very different. You normally think of these two as cousins, NASDAQ and Russell, and the NASDAQ clear breakdown all the way down to a 50 now. And if it goes below 50, then we go strongly bearish. And then again, at the same time, we have the Russell that's still holding up as very strongly bullish. Now, this may start to turn if indeed the rest of these start to continue the deterioration and join the rest, but very, very divergent between the cousins here. Now, this pair of cousins, they're in lockstep with each other, and they're doing just what you would kind of expect in their relationship one to another. In terms of the strength of the intermediate trend, it's still a strong bullish trend. And in terms of the hedge warning status, we still retain a level 1, which is our first level of caution. I suspect that we'll see that this will change sometime in the next few days as we see this situation play out. We could very easily go to level 1 plus or even the level 2 within a few days if this situation continues to deteriorate. We have started to see some changes come into the strategy opinions. Now, in terms of option income strategies, the VIX is still inside the acceptable window. We've not even gotten up to an 18 yet. So it is okay to initiate new positions. At the same time, clearly the market is showing some deterioration. So you might want to consider position sizing and also your strategy approach. Be a bit careful, perhaps more so than you would have been 2 or 3 weeks ago. And then some outright changes in terms of covered call strategies and put selling. Now, normally with an intermediate term bullish, I should say, an intermediate term S&P posture that is bearish, we would not initiate new short-term or intermediate-term bullish positions. So for many of you, especially novice traders, conditions are not acceptable to initiate any new positions at this time. More aggressive traders may still want to pick out your favorite charts, but you notice the ratios have changed here, and we've gone to a 3-to-2 ratio. So 3 contracts in the money and 2 contracts out of the money for those active positions. So much, much more conservative than we were a week and 2 weeks ago. Also, with your ratio of low beta versus high beta, start to run towards those more defensive oriented stocks and put your mix on your portfolio of covered calls into more low beta positions. And again, I'm talking about the aggressive traders. The novice traders, this is you're not even going to initiate any new covered calls at this point. Put selling also not acceptable for new core put portfolio positions for novice traders. Now, more aggressive traders, if you believe that this is just a pullback in a bigger bull market, you may find that this is actually a very good time to put on some put selling strategy positions. The trick to this is, of course, to be sure that you are using defined risk positions and position size and the scale you're willing to own. Because if you're wrong, and this is not just a bull pullback, and this is going to deteriorate into something much larger, you've got to be prepared to own those shares. And you see from the specific warning areas, we have a volatility ratio warning fired several days ago. Distribution day count continues to climb. We're now at NASDAQ 7, S&P 6. VIX phase has been increasing. The skew just a bit elevated. About a 9% probability of a 2 standard deviation move in the next 90 days. You see, of course, we went to market phase 5. That is a warning. Intermediate term market posture is weakly bearish. That is a warning. And you see the key intermarket risk aversion indicators now have had 2 of them roll over into signaling a risk off situation. And some of these others are starting to also exhibit characteristics of rolling over and probably are headed this way if the market continues to weaken. From sentiment, we do have medium-term risk is somewhat elevated. And then also Spain, oil producers, and energy, also high sentiment readings. So watch for potential reversal patterns. Fear and greed index has been coming down with the increase in volatility, and we certainly are no longer anywhere near that upper quartile. Things are coming back towards a more neutral area. In terms of specific ETFs and their intermediate term market postures, these are still holding up. So again, we're not confident that we are not just in a bull market pullback versus a bullish bounce in a bear market. So until this situation resolves itself, and this is what happens when you don't have a stack. Remember, we always refer to the stack. We like for these to all agree, and we like for them to all say, you know, short, intermediate term, long term, and across all four of the indices, all the same direction, all bullish or all bearish. Well, when we get this mix of signals, this is the kind of mess that we get into, where we have, you know, a fair amount of bullish signals, but then we also have all these warnings coming in. And, you know, as you follow these, as we move from one video to another, from one trading day to another, and you see the continuing deterioration and broadening of these warnings, you start to call into question, you know, which direction you think that is going. In terms of sector specific, you see this certainly is showing deterioration. Short to intermediate term, very few sectors are holding up well. Utilities, along with materials and energy, are holding up the best, but some of these are also very close to the signal lines, could also deteriorate very soon. As the market weakens, guess what? Utilities rises to the top. And indeed, if you look at the 5-day, utilities is the best performer for the week. And if you go back to a month, it's much more mixed. So it's been very much of a scrambled market as we oscillate. One moment it's all about defensive sectors, and the next moment it's about high beta, and then that doesn't seem to ever persist very long before things deteriorate and we flip-flop back. So it's been a very, very difficult market to gain any real traction before things kind of rotate. And that's been the story now for quite a few months. So we've gone probably long enough. I will mention the relative rotation graph. We update this weekly. Notice though, while utilities has been performing well on a relative rotation graph, it's been tailing down and has fallen from way up in the upper right to now, you know, into this lower right corner. So we'd rather be lower right than lower left, but still this is definitely tailing down. So but also look, almost all these others are also tailing over. Now the REITs, IYR, kind of moving up. ITB is also moving up. ITB is home construction. So some of these are improving. You need to keep an eye on those. FDN, ITB, IYR, the ones that are showing improvement, but also respect the fact that while these are tailing down, they're still up in the upper right quadrant. IYT, XRT, IYZ are also ETFs or sectors of note. Okay, let's go ahead and wrap this thing up. We've gone over our 20-minute limit, self-imposed. So we'll just roll through this. If you see something of interest, just hit the pause button, go to the hyperlink, and get the additional details that you're looking for. I think we had a lot of good information here today. Oftentimes on Monday, we are a teeny bit longer because of the amount of reading material that comes in over the weekend. Has often got a lot of very interesting stuff that I want to make sure I share with you. Disclaimers, as always, hit the pause button if you want more time to review the disclaimers. Do note the full disclosures can be found at this hyperlink right here. We'll see you back here tomorrow morning with the Falcon Global Market Preview. Good trading.